mindset show on the planet where we are giving you the insider's guide to living financially free, the insider's guide to wealth, everything about it. I'm excited about this next guest because, if you know my background, you know that I was a 15-year banking executive, a branch manager, CEO of a credit union, and the traditional way that myself and even others are taught about banking and the banking system is totally different than what you are, or what my next guest is going to teach you. He's actually going to teach you how you can become the bank yourself. How do you build wealth? How do you use your family? How do you create generational wealth? These are unconventional ways that are not really taught every single day, using instruments, financial instruments that you may think you know about, but you have no idea. I got my man, Mr. Marvin Mitchell, in the building. What's up, brother?
I'm good, man. How you doing, bro?
I'm doing well, man. I appreciate you, man. I think, I'm excited about, this interview for so many different reasons, right? Because, your knowledge base, first and foremost, your life story is phenomenal. The things that you've been able to do and acquire and who you are is just awesome. So for those who don't know, who is Marvin Mitchell?
Man, I'm just a kid that grew up in the inner city without a father, who grew up and became something of myself. Yeah. That said that I'm going to be a generational curse breaker. Yeah. That saw my family struggle and said, I'm not going to be the one to struggle anymore. Yeah. I'm not going to let my kids struggle anymore. So I really just took a different route in my life, man. I began to read and I said that I'm going to be a person who becomes well financially myself, so that I can change the whole world, man. And this is what I manifested. Yeah. This is what I believe in. Yeah. And this is what I'm doing today.
Yeah, I love that. And so talk to me about, what you do now, right? Because, you are a wealth builder in every sense of the word. Right. And talk to me about your business.
So I say I'm a wealth creator. Just to give you an example. Get people excited to show you what's possible, what I've been able to do. Yeah. Growing up poor to now owning a $2 million mansion, a couple of Lambos, and just being able to just live just financially free, where I don't have to be in the office and the office is still making money from me. And I was able to do all of that, 422 units of real estate, without needing to necessarily go to the bank for the down payment or any of that. I borrowed money from an untraditional place that I'm going to talk about today, without using any of my own money, using other people's money to build passive residual income for myself, while my money is still growing tax-free. So here's the thing. I make my money, Ash, make money 2 to 3 times off the same dollar before it ever circulates outside of my territory.
Oh, so your money makes 2 to 3. So let's unpack that, right? So you're saying if you got $1,000, right, that money make money 2 or 3 times before it even goes outside anywhere else.
Everything I have is going to be funneled to what I call a wealth creation fund first. And then once it funnels to that wealth creation fund, I'm going to borrow against that. When I borrow against that, I buy an asset. So now the asset is making money from me. And the thing I funneled it through is still there and it's still making money from me because I didn't take the money. Wow. I borrowed against the money. Wow. So give y'all a play. And we're going to talk about what it is in a second, but let me give y'all a play.
Wow, that's heavy.
Let me show you how to make money 3 times.
Man, you came out the gate with the bars.
We got to.
Yeah.
So here's the deal. Let's say I need to buy a high-price item. Yeah. I pay $20,000. I might use a credit card. I get my points for the credit card. Yeah. Then I borrow against my wealth creation fund, pay off that card. Yeah. I got points from the credit card. My money in my wealth creation fund is still growing tax-free. And I just bought an asset that's making money. Now that dollar made money 3 different times.
Wow.
So, you see, it's not that some people are not spending too much. They're just spending it wrong. If I can show you how to make money without reducing your lifestyle and still end up in a better financial position than somebody that tries to save and live so below their means that they feel like they can't spend any money. I'm going to show you how to spend money and make money at the same time. Why? Because it doesn't have to be a both and. It doesn't have to be an either or. It can be a both and. And that's what we're going to get into.
And I love that because, I mean, as y'all know, abundance is your birthright.
Yes.
And we always say that and is better than or, right?
Exactly.
And we've been taught to choose, right? And so, we got to choose. We got to create. All right, so this or that.
Yeah.
But you're saying, you could be responsible and spend. Yeah. You could have a Lambo and build wealth. Yep. You can have a $2 million asset and own 420 doors, right? Yep. Like, man, that's powerful. So take us through like what that it is. Like, what is it? What is this wealth creation fund that is allowing you to double and triple your money?
I want to talk about that. I'm going to start off by talking about the 3 different types of money. First, you got to understand the 3 different types of money. Then you can understand what this is. It's 3 different types of people when it comes to money. Yeah. You have a debtor, you have a saver, and then you have a wealth creator. We're going to talk about the wealth creator today, but we got to understand the debtor first. The debtor is somebody who always buys appreciating assets. They might buy it on credit. They spend their entire life living in a rat race. They're going to go in debt, and they're spending years attempting to become debt-free. Go in debt, attempting to get debt-free. We all know people like that. Surely none of you are, right? But we know people like that, right? Problem is their goal is listening to people like Dave Ramsey telling them that they need to be debt-free, they need to be at zero. Well, I will tell you the problem with that thinking is that when you're at zero, you're still at zero. There are homeless people on the street that are at zero, right? But at the same time, they don't have any assets. They're not building any wealth, right? Yeah. So then you go to the next stage where you got the saver. Now, the saver, that's somebody that's in a better position. They're going to save and see their cash go up. Yeah. But then when it's time to buy a vehicle or buy something, they're going to spend their cash. Then they're going to save again. Then they're going to spend their cash. Here's the problem with that. Every time they spend their cash, what they're doing is they're going back toward the same place that the debtor is trying to get to. So the saver is stopping the forward momentum of their money each and every single time they're getting back to zero. And here's the thing. They feel like they have to live in a scarcity mindset, like I can't spend. I'm going to live on ramen noodles. I'm going to live like no one else is living right now. Problem with that is once you have that scarcity mentality, you don't just click out of it. You stay in that scarcity mentality. I have clients like that that save millions of dollars but are afraid to spend $10,000 because they think they're going to run out of money because they've trained themselves to be scarcity. But as you know, abundance is our birthright. Yeah. So if we're going to think abundantly, we got to know that we can have it all, right? Yeah. So when you're abundant, you're going to become a wealth creator. The way a wealth creator thinks is I'm going to be responsible with my money, but when it's time for me to buy a high-ticket item, I'm going to borrow against something that's making money while it's still making money, so I can make money 2 to 3 times. So that wealth creation fund is actually a type of life insurance. But I want you to be careful because when people say life insurance, the first thing that you think of is, well, I got a term, or I got life insurance through my work, or I got a whole life. Let me tell you, most 90% of policies are set up the wrong way, and they are not built the right way to be a wealth creation fund. In order for it to be a wealth creation fund, you got to build cash value fast. You got to be able to borrow against it fast. You got to make sure that you're getting a good tax-free interest rate and it's growing for you uninterrupted even when you're using the money. You got to make sure that you don't have to pay it back. So if you structure it the right way, you don't even got to pay it back. It's just subtracted from your death benefit when you die. And the death benefit is always more than the cash value, and it's always tax-free. So when you understand this, I'm going to give you one play, and then we're going to kind of take you back. When you understand this, you can take educated risk. Give you an example. If I have $100,000 in a cash value policy, and I borrow $50,000. Let's say I was making 5%. So if I got $100,000 making 5%, the next year is $105. Well, if I borrow $50,000, next year is still $105 because I didn't touch that money. I just used it as collateral. I borrowed against it. So that 100 is $105,000 now, right? Now, get this. I borrowed against it. It's $105,000. Now, if I want to take that money and buy an asset, I can make money off that asset, and that money is still growing. And if I don't pay it back, they're going to subtract my $50,000 plus a little interest from my death benefit when I die, which is probably $1 million.
Right.
You see what I'm saying?
Right.
So to give you one play really quick, Ash. So what I did was, remember GameStop?
Yeah.
GameStop was just going through the roof. Now, I guess I should have told y'all this. I actually own a financial firm. Yeah. I've been owning a financial firm for 15 years, so I can kind of see where the industry is going. I know that the big guys are not going to continue to lose. Yeah. So when GameStop, the ordinary person was making so much money and winning, I said they got to do something about it. So it went up by 100 points, right? Then it went, and then I said it's going to go down by 100 points the next day. I positioned myself correctly where I was able to borrow from my policy and put $100,000 on an option put that it would go down by 100 points.
Yeah.
The next day when it went down by 100 points, I instantly made $300,000 plus got my $100,000 back. And I was able to pay back the insurance company the $100,000 while my money was still growing.
Wow.
Now, why would I take that risk? Because it's a big risk. Because if I lost that, I lose $100,000.
Yeah.
Here's why I'm able to take that risk. If I lose that and I don't have the $100,000, I'm not in a big deficit because it's simply just borrowed against the policy. And if I lose $100,000, the $100,000 is still growing as if I never touched it.
Right.
And $100,000 plus interest is going to be subtracted from my death benefit when I die.
Right.
So I use that money to be a win-win situation. Whether I win or lose, I still win.
Yeah, I love that. And so just to unpack that, right, because somebody's listening right now who loves the concept. Take me back a little bit, right?
Yes.
What is the difference between a term life insurance policy and a cash value life insurance policy?
Yeah. But first off, be aware of people who tell you that there's only one right way, right? So if somebody tells you that you should never do term, you should do permanent. Or if they tell you should never do permanent, you should only do term, I need to steer clear because there are ways that each one could be used. Like if you're young and you got a lot of debt, a term policy might be a portion of your of what you have. What a term policy is, exactly how it sounds. It's a term, which means it's temporary, which means if I get a 20-year term policy, that means I don't build up any cash value, I pay a premium, and at the end of that 20 years, that policy is done, unless they increase the premiums by a whole lot. But for most people, it's done. If I die within that 20 years, I get a death benefit. So I'm betting when I get that I'm doing this just in case I die within that 20 years. The problem with that is when you just only go term, you're attempting to get people to get life insurance for something that they don't want. People don't want to think about dying in order to get life insurance. And you can't use it for your life. You can't use it for a business. You can't use it to buy real estate or buy a vehicle. It doesn't have any other benefits except for death benefit. The exciting way to get life insurance is when it's for your life. See, life insurance is called life insurance for a reason. It should be for your life, not only death. If you do it the right way, sure, you can buy wealth while you're waiting to create it, but at the same time, you can use your wealth. Unlike you can use any other tool, like a 401k or IRA, you can't use any kind of products the way that you can use life insurance because it's liquid. You can control it. It's tax-free. It's creditor-proof. And you can only do that with permanent policies. Now, when you do a permanent policy, that's either going to be a whole life or it's going to be an index universal life. Those are the only two I advocate if you're going to do this whole become your own bank situation.
Yeah.
They both work different, but the one thing they both agree on is the fact that it's permanent, which means it's going to last you your whole life.
Yeah.
It's going to build up a cash value. In that cash value, that's what gives you the ability to borrow against it. And again, it's going to last your whole life. Now, lasting your whole life as cash doesn't mean that you're actually paying a premium for your whole life. You can actually structure it in a way that you only have to pay your premium for a certain amount of years and it still lasts for the rest of your life. But when you structure it, you got to make sure that you structure it in a way that you have the highest amount of cash value for the lowest amount of death benefit. Now, traditional advisors are going to tell you to get the highest amount of death benefit for the lowest amount of cash value, but they get paid more commission. It benefits them. It doesn't benefit you. I want to tell you how it's going to benefit you and benefit your family so that you can build generational wealth.
No, I love that. Yo, hold on. I know you guys are enjoying. If you really want